There we are. Hello there, and welcome to the first installment of Dowling Yahnke's personal finance webinar series. Today's topic, we will be covering credit. Over each of the next 4 Tuesdays and part of this personal finance webinar series, we'll also be covering the topics of budgeting, insurance, taxes, and finally, investments. For those of you who are not familiar with our firm, Dowling & Yahnke, we are an independent wealth advisory firm providing portfolio management and financial planning services. We manage over $4 billion of client assets and work with over 1,200 individual clients. A big emphasis that we have here at Dowling & Yahnke is on education, not only amongst our own employees and internally, but also to our community as a whole. We hope that this webinar series is just that, informative and educational, and we welcome you and are excited to have you join us today and hopefully in future webinar episodes. As I mentioned, my name is Eric Nelson, and I am one of the financial planners here at Dowling & Yahnke. My role at the firm centers around assisting our clients with their financial planning needs, particularly planning through, into, and for retirement. We'll also be joined by my colleague, Andy Christopher, who will be running things on the back end. Andy, I'll throw it to you to say hi.
Hi, good morning. My name is Andy Christopher. I'm an associate advisor at Dowling & Yahnke. As Eric mentioned today, I'm going to be mostly operating behind the scenes, helping to answer or coordinate our question and answer session. If you'll notice at the bottom of your screen, you do have the ability to submit questions, and we encourage all of our participants in today's webinar to please do submit any questions that may come up throughout our presentation. We'll try to answer our questions throughout the presentation. We've also allotted about 15 minutes at the end of today's presentation to answer all of your questions. Of course, if we don't get to your question throughout our presentation, we'll make sure to reach out to you directly via email. The one thing to note with that is you do have the ability to either submit your question anonymously or with your name. And of course, we will need your name in order to reach out to you with email if we don't get it to answer your question today. But looking forward to today's presentation. Eric, back to you.
Thanks, Andy. And just one other note, we will be recording today's webinar. So if you are joining us via the webinar recording and any questions do come up as you are viewing our recording, we also encourage you to reach out to myself or Andy via email with any of those questions. And again, we'll be more than happy to address those questions. So with that being said, we'll hop into the reason why we are here today, which is to talk about credit. And I think it's important to start first by defining what exactly credit is. And simply put, it's a contractual agreement between a borrower who receives something of value now and the agreement to pay back a lender for what that thing of value that they receive over time or at a later date. Commonly, when talking about credit, things like credit cards or loans such as mortgage, that's typically the first association with thinking of credit, but those are not all inclusive. Credit really does, again, I think this is an important distinction to make, is that it does involve anything where something of value is received upfront and then ultimately paid back over time. This distinction is important because as you first enter into that contractual credit agreement, that's ultimately where your credit history begins. And that's really the big point of focus that we will be concentrating on today. And your credit history really is a big part of your personal finances. So with that being said, again, why exactly does credit matter? Well, as I mentioned, as you enter into those first contractual credit agreements, you begin to develop credit worthiness. And that credit worthiness is not only applicable, again, to things like credit cards or like mortgages, but they really do apply to a lot of other life's necessities. Things as basic as where you're going to live each month and rent or use of a phone. All of these things rely on essentially credit-like agreements. In any of these situations, something of value is being provided up front, again, a home or a phone, and the lenders of that thing of value want to ensure that they will be compensated and paid for providing those services, again, per the agreement. All of these things, again, build into what your credit worthiness is. So again, it's not just applicable to credit cards or loans, but it really does affect some of the things that we come across very early in our financial lives in our everydays. Additionally, as you start to build up that credit worthiness and you develop a credit history, the lack of credit history or the lack of credit worthiness can also have an impact ultimately on some other costs, things like insurance premiums. So if we don't have strong credit and we are not deemed credit worthy, then certain things like premiums will ultimately be more costly to us in the long run. Additionally, credit worthiness and your credit history can also have somewhat of an impact on your employment. Certain employers and certain industries also request to check your credit as part of the hiring process. They do this to, again, get a sense of your financial trustworthiness, which again, some industries can relate to the risk that they have or that they deem, or the responsibilities that you may be able to in carrying out that job. So again, creditworthiness is not applicable to just one thing. It does cover a whole lot of different items and topics, ranging from where you can live to, again, ultimately your employment opportunities. Another thing to note, again, is as we do develop good credit and we build up that creditworthiness, it also can really be used to our advantage. So as we develop and strengthen our credit history, we really are able to accomplish some of life's larger financial goals in a much more immediate fashion. Things like buying a home or buying a car or even starting your own business, those sort of large purchases require larger upfront costs than typically our incomes can support and sustain on their own. This is where good credit can come into play, and again, it helps us meet and achieve those financial goals in a much immediate and faster fashion. So we kind of described exactly what credit is and why it's important. So how does this process actually work? Well, I think this graph does a pretty good illustration of exactly how the system works, the different parties and the different actions involved. So in any credit application or credit request, it starts out with the consumer or the borrower, the smiley face borrower right here. In this example, the borrower is applying for a loan from a bank lender. And they do this when they apply for a certain line of credit, or in this case, a loan. They're doing so, and it's tied to their social security number. That's the means of identifying the borrower throughout this credit system. Now, to be able to understand, again, what sort of risk that the lender is taking and whether or not they ultimately want to provide that thing of value, again, a loan in this example, the lender wants to understand the history of this borrower and of this consumer. And to do that, they work with these two other parties called credit bureaus and scoring agencies. And what these lenders work with and request from the credit bureaus is basically that history, that credit history of the borrower. And what the credit bureaus do is they continuously work with lenders who are requesting this information and other lenders who are constantly sending them information about borrowers' credit histories. And they're serving as a sort of a database to, again, keep track of all of that information. These credit bureaus ultimately provide what are known as credit reports, which, if you've ever seen any of those credit reports, they can be quite lengthy, and they're often put together by one of the three main credit bureaus, TransUnion, Experian, and Equifax. Because these credit reports can be quite lengthy and involve a lot of information, we also rely on, and lenders look to scoring agencies to somewhat simplify or to digest this database of information into a more concise evaluation of a borrower's creditworthiness. Again, credit scoring agencies, you've likely heard of the FICO credit score or possibly the Vantage credit score. But again, these scoring agencies take all of the information that the credit bureaus collect and send, and they calculate that credit score that, again, provides a more concise, easier to digest evaluation of a borrower's creditworthiness. So if you have heard of a credit score before, again, that is just a numerical expression representing the creditworthiness of an individual. It ranges from 300 to 850 for FICO, which is, again, the most popular credit score available. And your credit score begins or is first calculated after about 6 months once you first establish credit. So it's not to say that the first 6 months of your credit history does not count, but these scoring agencies do not put together or do not calculate the initial credit score really and usually until about 6 months after you've established that first credit. They want some sort of history to, again, evaluate before they ultimately provide that credit score. And within this credit score that they calculate, the scoring agencies typically place borrowers in respective ranges, ranging from very bad to bad, fair, good, and then ultimately to excellent. And these ranges, again, are based on the underlying credit score calculation. And they provide a further summarization of, again, kind of the borrower's creditworthiness. Depending on where your credit score falls and which range you fall into, it can have pretty significant financial impacts that will ultimately affect not only your ability to borrow money or utilize credit, but also the additional costs that you experience when borrowing money or utilizing credit. The example on the bottom right of this screen illustrates an example of a credit request for a mortgage. It's a $400,000 mortgage that a borrower is requesting from the bank. On the left side of the screen, it basically illustrates what the lender deems to be the borrower's risk, scored by their credit score, ranging from excellent, again, to bad. And to incentivize the lender to provide that upfront payment of the $400,000 mortgage, the lender will charge what's known as an interest rate, or in this case, a mortgage rate, which is essentially the additional payment on top of the actual $400,000 that they're paying out that the borrower is required to pay. This mortgage rate is very closely tied to the underlying credit score, and again is a measure of the risk that the borrower presents to the lender, and again that the lender requires to ultimately incentivize them to provide that $400 loan. As you can see, the higher your credit score, the lower your mortgage rate, therefore the lower risk that you are presenting to the lender. Alternatively, the lower the credit score, the higher the mortgage rate, the higher the risk, and again, ultimately the more that you'll be paying over the life of this particular loan. Certain individuals who do fall in the lower ranges, such as the very bad or the bad range, they can even potentially not be able to qualify for certain types of loan. We often see that with mortgages. If you are in the bad or the very bad credit ranges, oftentimes banks will not be willing to really provide that mortgage or that loan at all, because again, they deem that as too much of a risk given your credit history. So as you kind of follow along these credit score ranges and you do work with lenders and request whatever that line of credit is, in this example, a mortgage, obviously your credit score and your mortgage rate affect the amount that you ultimately pay. And obviously the higher the credit score you have, the lower monthly payment is. And as you can see in this far column, this total interest paid represents really the significant impact that these varying credit scores can have over longer periods of time. The difference between an excellent credit score and a fair credit score is almost $50,000. So clearly, credit scores are a very big part of the credit cycle and the credit equation. So it's hopefully this example illustrates that the financial impacts that can have on, again, higher and lower credit scores. So with all that being said, how exactly are your credit scores determined? Well, there's 5 main factors that we'll be covering one by one here that ultimately dictate what composes your credit score. The first being your payment history, which is the most important and most influential factor. Accounts for 35% of your underlying credit score. And your payment history simply tracks your history of meeting the minimum payments across your various lines of credit. So for things like a credit, it's simply the minimum payment that's listed on your credit card statement. For something like a loan, a mortgage or a student loan, it's the total payment that's due each month that includes a portion of the balance's principal or outstanding balance, an additional payment called an interest payment. So whichever types of credit we're talking about, the payment history really relates to the required payment. And obviously being the most influential and important factor as part of your credit score, payment history can have a pretty significant impact if you do not sustain and maintain a good payment history. For example, it can depend on your individual situation and your credit history and your underlying credit score, but even one missed or late payment can sometimes actually dock your credit score by as much as 90 to 100 points. Again, as you kind of develop a larger and longer credit history, missed payments will not become as important, but even one payment, again, can have a pretty significant impact on your credit score. And any missed or late payments will stay on for about 7 years of your credit history. So I think that the point remains not only is that it's the most important factor, but a single missed payment or a single late payment can have a pretty significant impact on that ultimate calculation. The next most important factor is the credit utilization rate, or the amounts owed, which represents 30% of your credit score. And your amounts owed is just really the amount of credit that you have available the amount of credit that you're actually borrowing or that you're utilizing over the amounts of credit that you have available to you, otherwise known as your credit limit. So with a thing like a credit card, let's say you open up a credit card and the lender is essentially saying that, let's say your credit limit is $1,000. It's allowing you to borrow up to $1,000, but it's not essentially lending you that $1,000 right up front. If you were to go to a grocery store and spend $100 at that grocery store, using that same credit card, that's actually when you start to borrow those funds. So in this theme of credit utilization, and in that example, the amounts that you owe is the $100, and the amount of credit that you have available to you is the 1,000. So therefore, your credit utilization is the 10%. Now, credit utilization, again, is the second most important factor of this credit score calculation. And typically, if you are able to keep your credit utilization below 30%, it will not, negatively impact your credit score. With that being said, if you're able to keep it even lower, again, ideally 0% or certainly below at least 10%, that's when this factor, this credit utilization factor, can actually begin to improve your credit score. So again, I think the thing to think about with credit utilization and to remember is it's not necessarily the total amount of credit that you have outstanding, but it's the amount that you actually access as part of that total credit balance, total credit limit, I should say. The next factor is credit length, which is simply just the average length of all of your outstanding credit lines. This accounts for 15% of your credit score. And obviously, it's something, time is not something that we can control, but as you are able to maintain various lines of credit and remain in good standing for longer periods of time, that illustrates to lenders that you are able to responsibly handle different types of credit. Again, you can't really control time, and it takes time to obviously build up that average credit length, but it is important to note that typically as you get into the 7 to 10 year range, that's when credit length as a part of your credit score actually starts to improve your credit score. You won't be docked for having credit length that is lower than that 7 to 10 years, but again, as you maintain different lines of credit throughout that period of time or up to about 7 to 10 years, that's again ultimately when you'll start to notice positive impacts as it relates to your credit length. Now, credit length again is a average of all of your outstanding lines of credit, so it is somewhat impacted by the next factor, which is new credit, which accounts for 10% of the credit score. Simply put, new credit is just how often and how frequently you open or you request new lines of credit. Now, this can be as simple as just requesting a new credit card or taking out a new loan. But this new credit, again, if it's done infrequently and not and responsibly and not too often, lenders understand that as people age and as they progress through their financial lives, they will want access to and request additional lines of credit. So utilizing and opening new credit accounts will not necessarily ding you too much if they're done infrequently. If you are opening up new lines of credit more frequently, that illustrates to the lender that there is some potential financial distress. If you're opening up new lines of credit, that implies to the lender that your outstanding lines of credit that are already available to you have already been used up, then therefore you're requiring or needing additional funds or additional credit to meet your outstanding obligations. Typical rule of thumb, I think the common question is, well, how often can I open up credit without potentially being negatively impacted? That again will kind of determine and be dictated by your underlying credit history and credit worthiness. But I think a good rule of thumb to follow is to aim to not open up a new line of credit more than at least once per year. Again, as you have built out your credit history, that number or that rule of thumb can kind of be adjusted, but particularly as you're starting out and beginning to build up your credit history, it's a good idea to reduce new credit requests and opening up new lines of credit more than once per year. Finally, the last factor that makes up our credit score is our credit types or our credit mix. This factor accounts for 10% of our credit score, and your credit mix is really just the different types of lines of credit that you have access to. Something like a credit card, where you're again given a total available credit limit that you can access as you need. Those are referred to as revolving lines of credit, and you have a revolving door that you can kind of access and knock on as needed. Alternatively, things like mortgages or student loans, they provide you with an upfront payment, and they require payments over a period of time or over installments. So those types of lines of credit are called installment loans. Your credit mix really just relates to how many different types of those lines of credit you have open and the variety of those types of credit lines. Again, this factor is not only one of the least impactful factors, but we listed here at the bottom of kind of what makes up your credit score because the credit mix that you have really will not necessarily negatively impact your credit score. As you're kind of building out and establishing credit, your credit type and your credit mix will not, cause that credit score to go down. But again, as you develop that credit history, your credit mix can be a really good opportunity to further improve your credit score. And again, further prove to lenders that you have, borrowing capacity and really borrowing durability. So these 5 factors are really the what compose your credit score, and again, they're weighted on different aspects depending on obviously your credit history.
Hey Eric, we actually have a question that's come in related to determining the credit score. And the question is, do you need to use a credit card on top of paying bills and utilities to expedite building credit? So I really think this gets into that credit mix question, and then really what is the best way or the best mix, if you will, to establish and determine your credit score?
Yeah, it's a great question, and we'll hopefully address that in a little bit more detail in a second. But I think really as you're establishing credit, it first comes down to really what's available to you. Credit cards can be one of those great ways to establish credit. Those aren't always available to new borrowers. So it really comes down to what your options are and what's available to you. But I think, again, the most important thing is to find what is available to you and to try to start utilizing credit and to start building that credit history as early as you can. So I think that question actually may tie pretty nicely into our next slide. Exactly, how do you get started? And as I mentioned, the most common way to get started is to open a credit card under your name. I think important thing to understand and really view your first credit card is that it should not be relied upon to increase your spending or to fund certain goals that you have, but it really should be utilized to build your credit history and to start your credit history. As you've kind of taken out or you've established and are comfortable with that first credit card, there's additional types of credit cards that can bring additional benefits. Things like rewards cards. Typically, these reward cards involve benefits like cash back. So for each purchase that you make at, let's say, a grocery store, these reward cards will essentially reimburse you or give you cash back based on that spending. Additional cards like travel rewards cards, where each dollar that you spend on those credit cards, you're accumulating benefits which you can apply to and pay for travel-related expenses. Again, credit cards are typically the first way to kind of be introduced into kind of the line of credit and to start building your credit history. But I think it's, again, important to kind of start small and to start basic. And as you become more comfortable with different types of credit cards, definitely taking the time to research what is available, because there are a lot of really great benefits through these reward cards that can be pretty applicable and can be pretty beneficial depending on your lifestyle and kind of your spending needs. I would note that these reward cards typically do carry an annual cost. So it's very important to do your proper research and understand what those costs are with those rewards cards, because typically the actual benefits that these reward cards advertise are not as attractive as they actually are in reality when you factor in some of those ongoing annual payments. As I mentioned, credit cards really are the one of the first ways to get started in building your credit. But the fact of the matter is, some banks aren't necessarily willing to act as really your first lender in opening up your lines of credit. So an alternative, if this is the case or if this applies to you, is to pursue some new borrower alternatives. And two of the best ways to really kind of supplement or act as an alternative to credit card is through authorized users and co-signers. So an authorized user relies on essentially a more experienced borrower. Typically that's a parent or a guardian, and that more experienced borrower adds a less experienced borrower, again, typically someone wanting to kind of get their credit history started. The experienced borrower adds that less experienced borrower as an authorized user on one of their lines of credit, again, typically a credit card. As an authorized user, you're able to utilize the credit card. You're able to, again, be exposed to exactly how credit cards work. Ultimately, the more experienced user or the owner, again, most likely a parent or guardian, they're ultimately the one who owns the credit card and is responsible for the payments. and the payment history will ultimately be reflected on their respective credit history. But if you are added as an authorized user, what this does is at least tells the lenders and credit bureaus that you've at the very least been exposed to the idea of credit. So again, it's not going to necessarily start building a payment history, but it will kind of begin that that utilization of credit that hopefully and ultimately may lead to a better probability that you'll be able to open up your own credit card. The other option listed there, cosigner, it works very much the same, where there's two users of the respective credit line, again, typically a credit card. But with a cosigner, it's essentially a joint owned credit card. So the more experienced borrower is jointly owning that credit card or that line of credit with the less experienced borrower. The only difference here is, again, just coming down to ownership of the card and the line of credit. But again, it's a great way to get started and to really start building credit if you're not able to get a credit card out solely in your name. And I think one of the last ways, and what I think is a very underutilized, but one of the potentially easier ways to get started in building history is utility services. So if you are renting out a home and the homeowner or landlord doesn't set up or pay for these services themselves, it can be a really good idea to volunteer to be the account owner for things like electricity or internet or water. If you sign up for an account owner, the payment history, again, for receiving and ultimately paying off and paying for those services, they'll be tied to your name and ultimately be reflected on your credit history. You're setting up and you're owning those utility services under your Social Security number. And again, what I think it's an underutilized and underappreciated way of beginning credit is typically when you're in a roommate situation, you're splitting those costs with your other roommates. So in theory, you're paying for and making the payments for those various utility services, and you're splitting that cost amongst your roommates, but the total payment history that is actually reflected, and again, tied to your Social Security, is solely yours. So again, if you don't have access to credit cards and you don't want to necessarily pursue new borrower alternatives, and I think setting yourself up and volunteering to be the account owner for your utility services can be a very, very good way to, again, kind of begin that credit journey and begin your credit history.
Hey, Eric, we have another question that came through related to credit cards. And for this question, it was any advice on how to pick the best credit card for you, or any best resources that you think are out there in terms of picking a credit card. And I think maybe going along with that a little bit is, we showed earlier what an interest rate may look like for a mortgage, 3, 2.5, 3.5, 4%. How does that relate to maybe an interest rate on a credit card?
Yeah, it's a great question. I think, addressing the first question of, how do you go about picking the best credit card for you? I think particularly if it's your first credit card, I think it's best to always start with the bank that you may already have a bank account set up with. So if you have, a checking or savings account at a traditional bank, it can be great to really start with that first bank to see if you can open up your first credit card with them. That banking relationship will have already been established, so that same bank will very likely or possibly be more willing to, again, kind of be your first access or first utilization of credit. So certainly starting with a bank that you already have a relationship is a good idea. From there, and to Andy's point, really, I think it's just doing the research on first, if you're wanting to kind of pursue a rewards card, what are the additional benefits and the underlying cost of opening up that credit card? And again, also understanding exactly what the terms are of the credit card that you're looking for or you're wanting to apply for. Certain credit card companies and certain credit cards have varying interest rates. Very often those can be in the double digits, sometimes up to 20%. So again, if you are utilizing credits, you want to understand exactly what is out there. And it really will obviously depend on your particular situation and what benefits or what sort of cost you're trying to obtain or avoid. But again, I think it just really comes down to researching what is available and really understanding the terms of whatever credit card you are looking to ultimately utilize. So we'll move on. For those of you who may have already established credit and already have credit outstanding, what can you do to really further improve your credit and your credit scores from here? Well, not to state a very obvious point, but the most impactful thing that you can do is just to continue to be or start to be a very reliable borrower. This, of course, involves on-time payments and keeping your credit balances low. And again, this may be a very obvious point, but I've certainly seen commercials that claim to be able to fix your credit fast or repair your credit fast. And the fact of the matter is, with those services, a lot of those strategies or a lot of those claims are things that we can control and that we can do completely ourselves at no additional cost. So really the most important thing and most impactful thing that you can do to strengthen and build up and improve your credit is just to continue to be a reliable borrower. Now, that second point of keeping your credit balances low is a little bit easier said than actually done. So if you are someone who has multiple outstanding credit balances and you want to come up a way or understand how you can keep your credit balances low and also ultimately reduce those credit balances, it very much starts with just first developing a repayment strategy. And the first repayment strategy to reduce those credit balances first should just be to commit to making more frequent payments. So again, most lines of credit or debts require you to pay once a month and have that minimum payment. The first strategy as part of any repayment strategy would just be to commit to making those payments more frequently, at least bi-monthly, but certainly more frequent is better. If you make those more frequent payments, it's constantly reducing and lowering your outstanding credit balances. So when those credit balances are ultimately reported from the lenders to the credit bureaus, they'll in turn be lower, which again will reduce your credit utilization rate. And as we mentioned before, the credit utilization rate is 30% of your credit score. So again, committing to and staying on and completing multiple payments per year will help you to lower those balances over time and ultimately lower balances which are reported to the credit bureaus and ultimately, again, make up a part of your credit score. So after you've made that commitment and you've identified the ability to make additional payments, there's really two additional strategies that I think are most popular in ultimately how to approach paying down your various credit balances. The first is the avalanche repayment strategy, which targets the outstanding credit balance with the highest rate. And the alternative is the snowball repayment strategy, which targets the credit balance with the lowest overall balance. Now, this example to the right in this chart is an illustration of a potential borrower who has 4 different lines of credit outstanding with varying balances. The avalanche strategy identifies again the line of credit with the highest interest rate and puts those additional funds and those additional payments towards paying down that balance. This avalanche again starts with the highest rate. So for credit card number 1, in this instance, for each dollar that you borrow or spend on that credit card, you would have to pay back $1.20 per the interest rate. The avalanche wants to reduce those ultimate payments and the amount of interest that you're charged. So using this avalanche strategy, again, directs any of those additional payments towards paying down that $5,000. Between these two strategies, the avalanche will make most sense from a purely financial perspective. Again, it will reduce your total interest cost over the life of the credit balance or of the loan. But it does take longer than some of the alternative strategies. Again, if you're putting payments towards a balance that is increasing at a greater rate than the rest, it has a higher interest rate. So as that balance is retained, it'll continue to grow at a higher rate. So additional payments will take longer to fully pay off that amount. But again, from a purely financial perspective, the avalanche repayment strategy will, again, save you interest cost over the term of the loan. Alternatively, the snowball, again, kind of attacks or aims at paying down the lowest balance first, in this instance, credit card number 2. The snowball can be really effective from a psychological standpoint. Directing additional payments towards the lowest balance, you'll be able to pay those balances off quicker, obviously having the lowest balance. From a psychological perspective, this again can kind of create a snowball where you start small and you pay off the smaller balances, but it does simplify your credit life and your financial picture. And again, from a psychological perspective, is hopefully paying off that initial lowest balance first begins that snowball and starts to roll down the hill where you're able to redirect those payments towards other balances as well once you've paid off that initial lowest balance credit card. Again, from a financial perspective, the snowball strategy, it'll allow you to pay off various balances quicker, but it will, traditionally cost you more in interest charges because, again, that particular strategy doesn't really focus on the interest rate or the interest rate that you're paying on the respective credit balances. But again, from a psychological perspective, it can be a really good strategy to just get started with that repayment.
Hey, Eric, we have another question that came through related to making payments on credit cards. So in this instance, the question is, does paying more than the minimum payment each month affect your credit score? In other words, does that improve your credit score more than just making the minimum payment?
Yeah, that's a great question, and it does. So that minimum payment, when again speaking to credit cards, is essentially the minimum payment that the credit card requires from you. It typically involves mostly interest, but it does pay down what's called the principal or the outstanding balance of the credit card balance. If you pay additional amounts beyond the minimum payment, whatever that additional amount is will be used to pay down that outstanding balance. So if you're paying down that outstanding balance with those additional payments, you're in practice reducing the amount of money that you're borrowing. You're lowering your credit utilization rate. So again, if you're paying down your balances and you're lowering your credit utilization rate, that credit utilization rate accounts for about 30% of that credit score. So a long-winded answer to the answer is certainly if you make additional payments beyond the minimum actually due for credit cards, it will lower those balances and it should have a positive impact on your overall credit score.
Thanks, Eric.
So finally, what can you do? After really again developing a strategy of how to kind of maintain and continue to be a reliable borrower. A very impactful thing that you can do is just to continue to monitor your credit score. The website listed there, annualcreditreport.com, is a great resource that provides access to free credit reports from each of the 3 major credit bureaus, Equifax, Experian. It allows you each of those free credit reports each year. So in theory, you could utilize each of those reports throughout your year and have 3 different credit reports that you can have access to. But at the very least, we'd encourage you to access and run those credit reports at least once every year. Not only will this allow you to kind of keep track and follow impacts and factors that have influenced your credit history and your credit score, but it also allows you to keep track of any discrepancies or errors that may occur on those credit reports. These errors and discrepancies aren't necessarily common, but they do occur from time to time. So getting in the habit of checking your credit score, and again, this is a free service each year from each of those 3 credit bureaus. Getting a habit of monitoring and checking those credit reports will make sure that you stay up to date on kind of how your credit has changed over the year, and again allows you to be able to correct and identify any errors that occur, and ultimately dispute and hopefully correct those errors if they do occur. So that being said, we will wrap up today's presentation with any outstanding questions that have come in that we have already addressed. So Andy, I'll throw it back to you.
All right. Thank you so much, Eric. From an administrative perspective, so the first question, or we've had a few questions actually come in today about are we going to be able to view the slides or be emailed forward or review the session? The answer is yes. So in about a week, a link to the slides as well as a recording will be provided to all of our participants. So we do also have a few other questions. So the first question for you, Eric, is would opening up a rewards card along with a credit card with your bank count as opening up 2 lines of credit? And then is there a certain time frame that would be applicable that is taken into account from calculating your credit score?
Yeah, those will be counted as 2 separate credit openings or establishing of new credit. Although they're at the same bank, the different credit cards or the different lines of credit are treated as just that 2 separate requests and 2 separate openings of new credit. As far as the time frame, again, I think a general rule of thumb is to try to limit opening up new lines of credit to at least once per year. There's no reason to open up a new line of credit every single year, but if you are wanting to open up a credit card and then explore something like a rewards card down the road, I definitely suggest kind of sticking through that rule of thumb and opening up that first credit card to, again, make sure you're familiar with that traditional credit card. And after that year has passed and you've basically proven to that same bank that you can reliably manage and utilize that credit card, then exploring something like a rewards credit card can start to make sense.
Awesome. Thanks, Eric. We actually have our last question that's come through. So this is a recent college graduate who's about to move out into an apartment on their own. And they have never had a credit card before. So they're wondering, I'm about to rent an apartment. A lot of times when I go to my landlord, they want to see a credit history, or they require sometimes even a credit history in order to verify that you're someone they can rent from. So what are some options that someone in that situation who doesn't have a credit card but needs to establish or show history of credit in order for them to kind of build credit moving forward?
Yeah, so it's a great question, and if you're not able to open up a credit card to kind of establish that first line of credit, in this particular situation, it sounds like you're renting out a house or apartment. Again, I think that's a really great opportunity to volunteer or pursue being the account owner of those utility payments. Again, you'll be setting up those accounts, the payments that you and your roommates will be sharing and paying while you're renting out that home and utilizing those utility services. That'll count towards your payment history on your credit history and your credit report. So again, that's a great way to initially build credit. As far as the landlord who may be seeking credit history to actually rent the property, in situations like that where you're not able to instantaneously generate or kind of utilize credit, typically those sort of situations require co-signers where again a parent or guardian may co-sign the lease with you. But as it relates to, again, particularly creating and establishing credit, credit cards can be that first great entry. And then again, utility payments for this particular example, I think would be a great way to, again, build that credit history and your payment history.
Yeah, great answer, Eric. We actually had one more question come through, so I spoke too soon on our questions. So in this particular question, the participant wants to know, to improve my credit score and reduce my interest rate, should I pay the balance immediately or should I make minimum payments?
Definitely, if you have the funds available, you certainly, out of those two options, would want to fully pay off the balance. Again, the minimum payments are just that the minimum amount that the lender is going to require you to pay. So if you're just meeting that minimum payment, it's not going to improve your credit score or your credit history at all. If you fully pay off those loans, and again, if you have the funds available to, that is going to reduce that line of credit or that outstanding balance to zero. So with fully paying off of that balance, your credit utilization rate will again be reduced because you'll have less funds that you're actually borrowing out of the total amount of credit that you have access to. So again, keeping those credit utilization rates as low as you can will definitely be a thing that you can do to improve your credit score. And again, that is looked upon favorably from the lenders, credit bureaus, and scoring agencies.
That's great, Eric. Thanks for your answers. So I think you've made us all credit experts at this point. We have no more questions from our audience.
Great. Well, again, I want to thank everyone who joined us today for joining us on the first installment of today's webinar. As I mentioned, over the next 4 Tuesdays, starting next Tuesday, we'll be continuing on with this webinar series, touching on the topic of budgeting. My colleague Hope Carlson will be leading that presentation on budgeting, and I will actually be back to join her. So I hope to see you guys all there. And again, I want to say thank you, and we do appreciate everyone's time today. Have a good one.